Our next speaker here is Steve Cinelli, and so he did go to Santa Clara University. He got his bachelor's there. He also has an MBA from Golden Gate University here. He's has 25 years in finance and strategy in numerous positions, a lot of senior executive positions there. He started at Bank of America and rose to be the VP of Technology Banking Group. And right now, he's a founder and chief strategist at Primark Q. Is that how you say it? Primark. Primark. So he's going to tell us all about it. So welcome, Steve.
It's nice being back down in Santa Clara. Campus looks a heck of a lot different than when I was here. But thanks for taking the time. And I'll go into Primark, simply put, where our vision is actually to change the way housing is financed in the United States. So it's a big, big proposition. But I wanted to provide a little landscape. It was funny, one of our advisors, a gentleman by the name of Andrew Kaplan, he's a professor of economics back at NYU, he recently introduced us in a session with a series of congressmen back in DC, saying that the market, the consumer is looking for solutions to the mortgage malaise, the housing malaise, through either Washington or Wall Street. Well, our belief is that the center of innovation is right here, the Silicon Valley, and I think we have a solution that's going to make a significant damper, or I should say a significant positive to the way housing is financed in the States. Let me lay a little landscape just so you know the extent of real estate in our economy. Real estate represents the largest, well, it historically has represented the largest component of GDP. Historically, it's ranged about 15 to 18% of GDP, with the correction over the last 3 to 4 years, it's down to about 10%, second only to healthcare, which represents about 12%. But nonetheless, housing, single-family housing as we know it, not commercial real estate, hospitality, and like, housing represents the single largest component of real estate. In fact, housing as an asset class in the United States is estimated to be about $16 trillion. 3 years ago, it was as high as $27 trillion. It's, again, the hugest, or the largest single asset class. For comparison, if you look at the market cap of all the equities on all the major exchanges, all the stocks, it amounts to about 14 to 15 trillion. So you can see the extent of real estate in the economy. Also, with the correction, we, over the last 3 years, we've probably seen the biggest wealth destruction in the history of the United States. As I said, at one time, the value of housing was at 27 trillion. It's now at about 15 to 16. So we've actually seen $12 trillion of wealth erode in the last 3 years. I'm sure there's a lot of folks that study economics. The impact of that wealth destruction has certainly affected the U.S. economy, because so many folks relied on the equity in their homes that tapped in for consumer purchases, for healthcare, for education expenses. So the impact of the wealth destruction is feeling the economy, the U.S. economy is feeling the effects, as well as the global economies. The Asian economy is way down. They rely so heavily on exports to the United States. Well, the consumer's not buying. And so there's a big ripple effect. Comes back to, housing is a very critical component of the United States. One of the problems with housing, as we see it at Primark, is the method by which housing is financed in the U.S. is fundamentally broken. Dating back to the days of FDR and the New Deal, the mortgage industry started. The creation of the FHA, the ultimate creation of Fannie Mae and Freddie Mac to guarantee mortgages to allow banks who lent mortgages to move them off their balance sheet and lend more. The thought at the time, and the mortgages, prior to the New Deal, was the approach was, we'll lend 50% of the value of the home. You've got to basically step up and bring the rest in terms of equity down payment. Prior to the crash in '29, everyone talks about the stock market crash. Well, equally as damaging to the economy was a real estate crash. Towards the tail end of the late 20s, we saw consumers who were buying homes that could only get mortgages of 50 to 60% loan to value started. There was a whole industry that came up in second mortgages, and the second mortgages allowed the consumer, the homeowner or home buyer, to leverage up to 80 to 90%. Well, as we are experiencing now, both in the residential side but also the commercial side, we have a big refinancing problem. A lot of the homes that levered up with second mortgages during the 20s couldn't refinance, and that contributed probably as equally to the Great Depression as the leveraging of equity securities, which we know the results of that. But let's look at the way homes are financed. Again, we date back to the 30s and the institution of sort of mortgage as the fundamental financing instrument. The belief at the time, and let's say it was carried out up until probably about 5 years ago, is that no one believed that housing was an asset that would ever depreciate. We always assumed that homes would appreciate by 2–3% a year, in some markets maybe more. And so from a lender's standpoint, the thought of lending 80% against it, they felt it was a comfortable risk, it was a prudent risk. In fact, certain mortgage programs started lending 90%, and then there was 100%. In fact, to stimulate the economy right now, the FHA has introduced under the Making Home Affordable program out of the administration, a 2.5% down payment and 97.5%, which is, from my standpoint, absolutely ludicrous. But going back, the belief, again, on mortgage lenders was that it was a non-volatile asset class. It would never diminish in value. Well, roll forward into the 90s and the 2000s, we saw the bubble. The two gentlemen before me talked about the bubble. And again, the fundamental belief is that the value would never diminish. Well, we saw a crash, and now we have lenders that have lent 120% of the current market values. That's a problem. The lenders are very concerned about regulatory pressures to write down their loans, because banks, for the most part, are highly levered to begin with. My father was a banker, and one of the comments he made is that if the bank lends you $1,000 and you can't pay it, you're in trouble. If the bank lends you $1 million and you can't pay it, the bank's in trouble. Banks are highly levered. If everything goes right, you can pull the balance sheets or the financial statements, the income statement of the banks, and very few banks even achieve a 1% return on asset. The margin of lending is very, very small. And all of a sudden you see these banks that are completely underwater in terms of 20–30% in excess of their collateral value. Well, they can't afford to write it down, because what happens is it hits their capital account. And I'm assuming that most people have somewhat of a sense of financing or finance. And so the banks can't afford to write these loans down, which is problematic, because if they did, they'd wipe out their capital account, and you'd see Bank of America and Chase and Citibank. They're virtually insolvent organizations. The government's got to continue the problem, which are really problematic for sort of the future of the economy.